Hey traders, Raghee here, and in tonight's free video from Simpler Forex, I'm going to talk about what's on the tip of everyone's tongue. Is the Fed going to go full-on hawkish tomorrow between the statement and the presser? And what does that then do to the US dollar? Now, whether you're looking at the Euro US dollar or the US dollar index here, the futures contract, remember you're really looking at the same thing. Euro US dollar is the euro's relationship obviously to the US dollar, but the dollar index is very much the US dollar's relationship back to the euro because the dollar index futures basket is nearly 58% euro, which means well over half of this index is euro, and therefore the relationship is almost tick for tick inverse. So whatever happens here, the opposite, nearly the opposite, is going to happen on the Euro US. One of the larger prevailing opinions out there is Goldman Sachs. They've got the tallest podium, they've got the loudest megaphone, and they've been talking since last year about potentially 4 rate hikes. Now, a company like Goldman Sachs is not without an ego. You put a claim like that out there, they haven't really let that go. So as far as hawkishness goes, you're going to hear some of the most hawkish talk from Goldman because they've already committed to that opinion. Doesn't mean they have to be right, because guess what? Just because they're talking doesn't mean that's where their money is going. So let's talk about where money is going. And for me, the opinion is best expressed by the way in which traders have positioned themselves in Fed fund futures. That means someone's taken their capital and put it to work in Fed fund futures, either long or short. Now, we can see the rollover here in the Fed fund futures. And just so you know how this works, this movement, red grab candles rolling through the support of the wave, this is actually US dollar bullish if you consider it to be reflecting that traders are expecting, Fed fund futures traders are expecting a more hawkish Fed. The reason I'm focusing in on the June contract is because we have expectations for the Fed to go hawkish sooner, because we are actually not quite at the dual mandate of jobs and inflation, but we're getting awful close. And a lot of traders feel that if the Fed is late to the party, the economy is going to overheat. So they're going to want to be fairly preemptive about it. Suddenly, we're seeing the June contract spring to life and start moving lower, indicating a higher chance of a Fed hike possibly in June. Now remember, the September and December contracts have been looking fairly certain that we're going to see that rate get down to say 99. You can see here that 99.42, we would see that rate get down to 99.25, which would be a 0.75 Fed funds rate. Remember, we're at 0.50 right now. So how do we position ourselves? There's 2 ways traders can position themselves in front of any kind of economic report, and that is to either be pre-positioned, which I would recommend by looking at calls. And the reason I'm picking calls isn't because I'm necessarily bullish, but we are closer to support. So it's easier to position myself long as we're closer to an oversold support level in the dollar index. On the flip side, you could think about how to sell euro near that 112 area. So pre-positioning means I've got a position before the event, and I'm using the event for follow through. The other side of the coin in terms of positioning is what I call catch the wick. And that is, how do I take advantage of a fairly predictable amount of price movement, the volatility that we typically see? How do I wait for that price movement to push the upper limits of either the tick or pip price movement, identify where the market could exhaust, and position myself with or even slightly after the information hits the airwaves? I prefer the second, and I call it catch the wick. And that to me is capitalizing, getting opportunistic on the volatility. It's a better risk-reward ratio. And in tonight's premium video, I'm going to outline all the different opportunities that are lining up for these catch the wick trades. Now, again, what I would love for you to do, knowing that we're sitting near the support of the US dollar and the resistance of the euro, think about where you can buy US dollars and sell a weaker currency. One great place to do it would be to go to simplerforex.com/heat map and look at the way the US dollar is positioned against other currencies. Who is it stronger than? Who is it weaker than? And that's going to build your watch list.